Crypto, gold. These days, nearly every investor has an opinion on them, and nearly every commentator has an angle. But true clarity on whether these and other investments beyond traditional stocks and bonds belong in your portfolio is harder to come by. The answer, it turns out, depends on who's asking. Welcome to Season 2 of Better Vantage by Vanguard, a podcast series hosted by Custom Content from WSJ and Vanguard. I'm your host, Christine Kashkari, Editorial Director at WSJ Custom Programming. And with me is my co-host in this series and our resident expert, Joe Davis, Global Chief Economist at Vanguard. Joe?
It's great to be back, Christine.
And today we are joined by Roger Aliaga Diaz, Global Head of Portfolio Construction and Chief Economist for the Americas at Vanguard, and Del Stafford, Vanguard's Head of Advice and Wealth Solutions. Together, they're going to help us cut through the noise around non-traditional exposures. Roger, Del, thanks for being here.
Good to be here. Thanks for having us.
Thanks. Excited to join the conversation.
If you're at Vanguard, if you're in the industry, if you're looking for someone to say, you know what, how do I think about some of these investments? What's the role in the portfolio? What are the assumptions I need to make? What are the risks I'm trying to mitigate? These are two individuals that I would look towards to give me perspective and thinking. I'm really excited today. Today's about, I think, dispelling some myths, some misperceptions, also some of the hype around some of these investments.
Yeah, I was looking forward to sitting back and watching you all duke it out.
Right.
But, when we talk about alternative investments, this isn't exactly new territory for Vanguard, though not many people may be aware of that. But I think the reason that we're talking about it now is because of their potential inclusion in retirement plans and the fact that the way that you can access some of these assets is evolving. So how is your approach evolving with these developments?
It's true that we've been talking about alternatives in the sense of, for example, things like private assets. There are other income-generating assets that are not necessarily fall in the more traditional bucket, if you will, of stocks and bonds, right? That definitely have a place in a portfolio, especially in a gold-based portfolio where it's retirement, call it saving, right? And then there is other set of alternative assets that are more being talked nowadays, right? That perhaps we've been looking and thinking about it over the years at Vanguard, but we haven't made them available as part of the portfolio, right? So very excited to discuss that. To me, one thing I like to think about in thinking about these assets is whether they are income generating or not. Because, I mean, these labels, alternatives, core, non-core,
non-core,
they are a little bit fluid. And to me, the big set of assets or categories of assets are assets that create income. Investors can receive a cash flow, stocks, bonds, but it could be direct holdings, could be real estate. And then you have these assets that are non-income generating, assets that you can hold, like, for example, commodities, or could be maybe art collections, right? Some of the assets could be very important for the economy, right? Like metals and other important commodities. But the thing there is that the value is determined by supply and demand. They don't create an income. So now how you think about those in the portfolio is like, are they going to create wealth for me because the price in the future will be higher than what it is today?
What's your view, Del?
So when we think about alternatives, just simply, the S&P 500 has a market cap of 60, 70 trillion. You compare that, gold has a market cap of call it 15 trillion. That's actually larger than the FTSE 100, right? Which is the UK stock market. And so when something gets that large, then it becomes a question of how. Are they too big to ignore? And are they more accessible now than they were previously? Over time, you would expect that something that is non-core today may actually be considered core theoretically in the future. And that could happen just purely due to accessibility. We think of what ETFs have done in the industry to bring transparency and to bring assets that don't trade very frequently to exposing them now. The same is happening in private market space now. So with the advent of evergreen funds, I think 2025, at the end of 2025, evergreen funds represent about $500 billion. That number was $250 billion maybe 5 years ago. So now they're more accessible. The retail client or a wealth client has that access. So we've gone from exclusivity from a private markets perspective to one that's more accessibility driven.
The other example I wanted to share for investors outside the US or even particular investors, for example, in emerging markets, some assets that you will consider non-core, like a cash position in a hard currency, like in US dollars, which here it would be crazy to say like I'm holding a big part of my portfolio just sitting in cash. In some countries where there is a lot of currency risk and macro risk, actually a strong position on currency could actually be your safe asset almost, right? So all these things shift over time and across regions as well.
And then not to get personal, like Argentina, which I
I'm
believe
from
you're
Argentina,
from.
so I'm talking of experience here.
It's from experience, right? So,
So the idea of having money under your mattress is not crazy over there, right? Because it's
that'll
US
get
dollars,
to what
for
we're
example.
talking about in the portfolio, right? So maybe we'll go to specific camps because I'm thinking if I'm a U.S. investor,
Yes.
gold sometimes comes into that conversation potentially as U.S. dollar could lose value. How would you attack from portfolio construction? How do you attack it from an advice perspective?
There are some truths and some misconceptions about gold, and it's a question that we've been actually talking to clients for years, right? There is a store of value type of role of gold, which I completely agree, right? I mean, if you see over 100 years of data, you will see that the return for gold has been keeping track with inflation, sometimes even ahead. Of course, it's very time period dependent, right? There are periods in which, okay, if you're in the 70s, you get like 20% per year, right? But even the last 14, 15 years, as much as we are looking at the gold prices today, the return since 2013 is 1.1%, right? So I think gold over time on average keeps track of inflation, preserves value, and that certainly is a role that sometimes people think. Gold to me is a hedge against more extreme scenarios.
Yes.
Not the regular garden variety inflation shocks. As long as the US dollar continues being the reserve currency, international reserve currency, the flight to safety, the risk-off events go to the dollar, right? The question is, Joe, you were saying before, is dollar debasement, currency debasement.
Fiscal
That's more
crisis.
extreme fiscal crisis, right?
Yeah.
So I think when people think about gold, they think a store of value, the historical, and remember, the gold was the reserve currency asset before the dollar was, right? So the people say, okay, the dollar is not there, and there are no other reserve currencies that are ready to take the stand, like the euro or the renminbi, then people go back to gold metal, right? So, and that's the type of thinking I'm sure investors are thinking when they bring their gold position to the portfolio.
So we do have clients from time to time who've either made a gold purchase or are considering a gold purchase. And when they do, they ask us and get context on how they should consider that relative to how we might be advising them already. So just a few stats as it relates to gold. Correlation historically is about 0.13 to the S&P 500. Really pretty low. Not as low as bonds, but we know there's some diversification benefit. At the same time, we know that there's more volatility, certainly more volatility than bonds. So that interplay between the correlation and the volatility, that allows us to then size how much, right? And so if you want to have gold for, we'll call it a tail risk event, we can help clients think through what does that look like. And now we just have to figure out how best to approach that and bring it into an existing portfolio.
In a nutshell, Del, before we move on to our other alternative assets, which investors should own gold?
In the way that we would consider this, it's going to be those that first have a full understanding of what the intended purpose is for actually holding the exposure. That's first. Second, it's going to be those that have a bit more equity in their portfolio, so their asset allocation allows for them to own a little bit more because we have to source it from somewhere. And so if you have an investor where the majority of their assets are in fixed income, and we have to sell fixed income to buy it, now we're giving up income. We're giving up some level of stability. If we sell the equity, they don't have a lot of equity to begin with, so then we're giving up the economic growth. So the profile of client would be someone that has more exposure to equities. We can be more thoughtful of how we're sourcing it. And then also the purpose for buying the gold doesn't play out. You have enough exposure in those other assets that it's not as detrimental.
So let's transition from gold to digital gold. So when we talk about crypto, a lot of people just think of it as one bucket, but it's actually different things with different implications for your investments. Can you talk us through that?
The most common idea around crypto is kind of Bitcoin, right? With the cryptocurrencies that are meant to be currencies are used for transactions. The value of the currency fluctuates a lot up and down because ultimately it depends on the demand and the use and the availability, right? So what is happening, whether or not Bitcoin is going to end up being an actual currency or not, is that today they behave like a commodity, right? Like the same than gold. Like you could ask whether gold is going to be a currency or maybe was a currency in the past, right? Commodity-based currencies. the Bitcoin and cryptocurrencies, in that sense, they are commodity-based type of currencies. From an investor perspective, which is what we really care about here, is as opposed to monetary policy, right? Is about how they fit in the portfolio, right? Can they generate return, and what are your views about the future demand for these currencies, where it's kind of upside from the return perspective?
We could widen the aperture and really bring in just tokenization in general. Just use stablecoin. It's backed by underlying assets. Most of the assets today that are backing those are U.S. Treasuries. And who knows, in the future, they may actually pay an income. So then it feels more like it's just a different wrapper for an underlying investment. So we've seen the mutual fund innovation, we've seen the ETF innovation, and tokenization just provides another wrapper for underlying investments.
Let me go back to Bitcoin. So let's say there's a listener out there, hypothetical or otherwise, they got a 10% holding, right, of their portfolio. Not judging it. What are the assumptions that's a viable position in the portfolio?
I think, Joe, you're talking about the right things in terms of risk and return. Basically, the hypothesis there has to be the expected return.
So the future price.
The future price, which in the case, because there is no income generation here, is really about where the price is going to be in the future, whatever the investment horizon is, will compensate or reward you for the risk you're taking. Just for context, like the volatility of Bitcoin right now is in the 70 to 80% annualized volatility.
Which is
right?
what? Help me.
It's 4 times the stock market, right? The diversified stock position, right? So now
it's high octane.
High octane. Of course, the return that we have seen, even after the fall, like if you have held Bitcoin for the last 10 years, it will have paid off, no question, right? Now, the question I would tell that investor to ask themselves is basically, do you think that will continue? So I was discussing before with gold, there has to be a conviction on what drives the value of that currency, or the cryptocurrency in this case, forward, and make sure that that's kind of proportional to the risk you're taking, right?
Yeah, I would say if a client approached us and said they had 10%, or a potential client approaches that we have 10% in Bitcoin, I think there's 2 we believes. And the first we believe is that it feels a little bit like portfolio insurance, but not really insurance. It's what if this happens? I feel as if I might miss out, right? It's what if. I've seen historically, it's usually based in history, I've seen this historical price appreciation. What if it continues? And then if you're answering the question, what if it continues, 10% might seem like a lot. Right? So then we could have a discussion with them around, well, how do you size that? We have to think about its correlation, and we then have to think about the risk. You said 70, 80% is the volatility. Correlation to equities, it's positively correlated. So as equity markets go up, Bitcoin goes up. If equity markets go down, there's some positive interaction between those two. That leads me to believe that 10%, depending on the we believe and the why, it seems like it might be a lot. So there's ways for us to size that appropriately in a way that you're not giving up, again, too much income generation, too much economic exposure relative to buying something for what you believe may happen in the future and not missing out.
Yeah, and for the record, I don't have 10%, but I also don't know what the fair value is.
Right, because it's not value-based.
This non-income based, right?
We're talking about if you have a personal view on where Bitcoin prices are going, we have a view too, right? Like in terms of we have like drivers of that view. One is there are multiple cryptocurrencies. There is no one. So now you say, okay, if Bitcoin is going to be used as a currency, what about all the other cryptocurrencies? And so there is currency competition there, and that's going to keep the price on check.
And Ethereum has more utility.
Keep the price on check.
Right, and Ethereum has more utility than Bitcoin, right?
Exactly. Yeah. Exactly, because the Ether is the currency that works in the platform, so and that has like a real source of demand.
Yes.
So that's one thing to keep in mind as you're thinking, like, okay, I may think that Bitcoin price will go up, but what about all the other 100 cryptocurrencies out there, right? And how the competition plays out.
Yeah.
And the second thing I cannot stop thinking when I think about the future of cryptocurrencies is like, if they are going to be actually used as currencies, we need much more of them, which will lower the price.
What I hear some say, no, its supply is fixed.
Right.
Well, that's the opposite.
Going up, and so the fair value is going to have to go up.
Right.
So you're saying it's the opposite.
It's
but that would be if it becomes the
in order to become a currency, right? An actual currency. Yeah.
Maybe we switch gears now. Talk about private assets, private markets.
So we know private credit, private equity, what they are. Why? I guess I'm more interested in the why. Why are they so just controversial right now?
Today, and over the course of the past, call it 3 to 5 years, it's become more about accessibility. Yes, the regulatory environment has made it easier for the mainstream to access these products. Beforehand, there was much more exclusive. Now, it's much more accessible. Now that it's more accessible, there's more eyeballs on it. The other thing that's changed as well is within this innovation have been liquidity parameters that were provided within private markets. This typical private markets portfolio that's not considered a quote-unquote evergreen strategy, there's lockups up to nearly 10 to 14 years. When you're in an evergreen type of a strategy, there is only certain periods through which liquidity can be accessed, and that liquidity can be gated at times. That's where portfolio construction is even more important.
I would say these private assets are complex assets. There is a little bit of opacity in the sense that there is no mark to market, you cannot see the prices, you don't understand the volatility. So traditionally, more sophisticated institutional investors have been doing a lot of work, and with big teams, they're like descending on this, understanding exactly what the risks are and incorporating the portfolio. If you're an endowment fund, you have infinite investment horizons. Also, you can have that. If you are saving for college, like you may not, right? So that has been the traditional use, and the reason why things are turning is because, again, your point, like these new innovations with evergreen and the ability to subscribe, right, and get redemptions in a more regular base,
and strong returns,
and strong returns that they always have. So accessing those strong returns, but in a more fluid way, and that's where. The question is being asked, do they belong in retail portfolios?
To your point, there's 9,000 global equity, public equity companies. I saw a piece of research that it's close to 215,000 private-backed companies, venture and growth equity-backed companies. So there is a real economic gap that exists between just client exposure. So if we Vanguard's been known for indexing for quite some time. So just on that alone, the majority of those are small cap. I mean, those 9,000 companies far exceed in market cap those 217, but it does give some real, it puts real numbers of what the investors are missing, and those could be some of the high growth companies that will become a part of those 9,000 public equity companies down the road.
I hear, some institutions, you have the consultant community, you should have 20%, 30% in private assets. Is that appropriate number?
You won't like my answer, right? Because
it's a leading question. It's a leading question because I think we have to be more thoughtful. That doesn't mean one would not have an allocation.
Absolutely, 100%. Yeah, and that's what I mean. I think a misconception out there is that you size a bucket. Say, I'm going to put 30% of private asset in my portfolio, and then you go and try to find a manager to fill into that bucket. But the reason why I think that's wrong is because how much it makes sense, it really depends on the particular risk characteristics of that private manager. So private assets are no different than public active in the sense that you access them through a specific manager. You're now exposed to active risk. Is that manager going to outperform or underperform? If it is going to underperform, obviously my allocation should be zero. Right? I don't know that ex-ante, right? But what's the active risk? There is the liquidity, right? How much ability to withstand illiquidity events do I have especially as a retail investor, right?
If you look at the average retail or wealth investor today, it's somewhere between 2 and 5% of an allocation to private markets. Somewhere between 5 and 10% on the upper end. The environment's just not there yet, largely because the accessibility for the traditional wealth investor isn't there yet. Right. If you referenced it by the ultra high net worth that are buying those traditional private structures where they're comfortable and they have the liquidity to hold assets in a lockup that's 10 to 14 years. That's a very different profile of client, and in that instance, it's the traditional. Endowment model had a much higher weighting to that, where it was basically private markets and index. And there it was north of 30 or 40%. And that is not the case for the wealth investor.
So it's been great. We've covered gold, crypto, core, non-core, whatever that is, and importantly, private assets. So Christine, we covered a lot of ground.
Yeah, absolutely. And Del, Roger, it has been so fun having you on set today. What is your takeaway, if you have one?
Yeah, from my side, it's okay to think outside the box a little bit with these new investments and this expanding set of investments. Just keep the risk mindset and also be willing to kind of change your convictions, right? Your point of view to make sure you cover the full set of facts as you invest in this.
So I think we've covered, as you said, Joe, we've covered a lot of ground. And I think there's a lot of, there's some key themes that have come through, both on how to think about underlying asset classes and also how those asset classes may play a role in a client portfolio. And as I approach this as an individual and also in the investment methodology and the advice that we're delivering, these exposures are ingredients and it's a recipe. And we need to make sure that whatever ingredient we include, we think about how it is additive to the overall recipe that we're ultimately making. So it's great to have a discussion around them episodically or individually, but at the end of the day, it's really about the recipe, how we're including it. And I would leave investors, like investors should be thinking about it in this very same way. There may be an acute reason why you want to buy it, but at the same time, you need to understand how that fits into the overall recipe of your goals and your plans.
Roger, Del, it has been such a delight. Thank you for being here with us.
Great to be here.
And thank you for joining us for another episode of Better Vantage by Vanguard. And if you haven't already, please subscribe or recommend us to your friends. If you enjoyed this episode and found it helpful, subscribe and share.